You opened your portfolio yesterday and your hands actually shook. SK Hynix crashed 15% in a single day, the worst one-day drop in 18 years. Samsung fell 10.7% right alongside it. Billions wiped out before lunch. Here's the answer before anything else. Semiconductors are not dead. Nothing about the chip industry broke. What actually happened is stranger, and once you see it, you'll never read a semiconductor crash headline the same way again. Why does this matter to you specifically? Because right now, everyone else is reacting to the headline. By the end of this video, you'll be able to tell the difference between money that's running scared and money that's actually leaving for good. And that difference is the entire game. I'm Moon. I track where money actually moves, not where headlines say it moves. If you've been staring at your portfolio wondering whether to panic, hit subscribe now, and if this video helps you see things clearer, drop a like. It genuinely helps this channel keep going. Now here's what almost nobody explains correctly. The money that fled semiconductors wasn't scared of chips. And here's the twist. It wasn't even the investors' own money to begin with. It was borrowed. Goldman Sachs said it plainly. Leveraged money is unwinding. Not investors lost confidence in chips. Leveraged money is unwinding. That's a completely different story, and it's the one nobody's telling you on the news. So why did borrowed money suddenly panic? Here's where it gets genuinely interesting. The culprit was never semiconductors. It was interest rates. And once you trace this chain, you'll see it coming next time before Wall Street even reacts. You're probably thinking, wait, wasn't AI supposed to lower prices for everyone? Then why did your electricity bill go up? That contradiction right there was the very first crack in the AI investment story, months before the stock crash even happened. Here's why. Building one data center isn't just servers, it's GPUs, industrial cooling systems, and an entirely new power grid connection. According to the Bank of Korea's New York office, the cost to build data center capacity has risen 17.8% every single year since 2020. That's not inflation. That's a structural cost explosion. Now let's run the actual math. Big tech used to spend around 30% of their operating cash flow on capital expenditure. This year, that number jumped to 70%. Next year, analysts project it hits 100%. But read that again. Spending everything they earn just to keep building. So if they're spending more than they earn, where's the rest coming from? Debt. Meta, Nvidia, and Oracle each issued $25 billion in corporate bonds. Amazon raised $37 billion. Alphabet sold $20 billion, including bonds that don't mature for 100 years. This isn't cash-rich companies casually investing anymore. This is leveraged expansion. And here's the psychological shift that changes everything. Big tech used to be considered rate-proof. So much cash on hand that a Fed hike barely registered. But once they started funding growth with borrowed money, rising rates started hitting their bottom line directly for the first time in years. So the bond market reacted before the stock market did. Bond markets always move first. SpaceX issued a 30-year bond, and in under 2 weeks, its yield jumped from 6.7% to 7.3%. Translation, lending. Big tech money just got noticeably scarier, and the smartest money in the room saw it before anyone else. It gets more specific. The 5 biggest hyperscalers, Amazon, Google, Meta, Microsoft, and Oracle, are now issuing bonds that yield 0.6 percentage points higher than other companies with the exact same credit rating. The bond market is literally pricing these AI giants as riskier than their own credit score says they should be. Now pour gasoline on that fire. Treasury yields themselves rose independently. The U.S. 10-year hit 4.6%, and the 30-year broke above 5%. Think about that. If you can earn 5% a year just holding a government bond with almost zero risk, why would you keep holding a volatile AI stock that might not even beat that return? And valuations were already stretched before any of this. The S&P 500's forward price-to-earnings ratio, or price relative to the next 12 months of expected earnings, sits at 21.3 times. The long-term average is 16 times. The market was priced for perfection, and perfection is a fragile thing to be priced for. So when rates rise, Big tech takes two hits at the exact same moment. One, interest costs on their new debt spike upward. Two, their already expensive stocks suddenly look even more overpriced because higher rates make future earnings worth less today. Hit with both at once, leveraged money is always the first thing to run for the exit. That's exactly why foreign investors pulled $110 billion out of the Korean market in just 6 months. This was never about hating semiconductors. It was profit-taking after a fast rally, combined with clearing out the exact positions most exposed to rising rates. First, fast and without apology. Now, you're probably thinking, oh, okay, but doesn't all of this still mean semiconductors themselves are risky? No, and this is the single most important distinction in this entire video. What got sold off was leveraged positioning built on debt. It was never semiconductor fundamentals. Here's your proof. Micron's operating margin right now sits at 85%. That is a level almost never seen anywhere in semiconductor history. If earnings were actually collapsing, a margin like that simply could not exist. The industry is making more money per dollar of revenue than it ever has. Samsung just posted record-breaking earnings. SK Hynix successfully listed ADRs on the U.S. stock exchange. Good news kept arriving during the exact same window that sell orders poured in. Which leaves only one honest conclusion. This was never an earnings problem. It was a funding problem, a completely different animal. Here's where it gets genuinely interesting again. When Meta announced it would sell off spare computing capacity, the market panicked, assuming AI investment itself was being cut. But that read is wrong, and understanding why is where this video actually pays off for you. What big tech is actually cutting isn't investment. It's tolerance for bad ROI. AI infrastructure is still the single most important competitive battlefield they have. So don't read this as the spending stops. Read it as the free money era is over, and every dollar now has to prove itself. And here's what almost nobody is telling you. This could genuinely be good news for the semiconductor industry long term. The era of throwing money at anything with AI stapled to it is ending. What's replacing it is an era where capital flows precisely to where it's actually earning a return. And that's a healthier industry, not a weaker one. So here's the bottom line, stated as plainly as I can put it. What's shaking right now is leverage short-term money, not the semiconductor industry itself. Capital is still flowing into chips every single day. It's simply become far more selective about exactly where it lands. So, what do you actually do with this? I'm not telling you to buy anything right now. That's not the point of this channel. What I am telling you is this. Next time a headline screams, "Semiconductor crash," stop for 1 second and ask whether that money left because of debt or because of earnings. That one question changes how you read every single panic headline from here on out. Here's the one habit that puts you ahead of almost everyone else watching this market. Bond yields are the dashboard smart money checks first before stocks even move. The exact day Treasury yields spike is the exact day leveraged assets start shaking loose. Remember, just that one thing, and you'll consistently see moves half a step before the crowd does. Let's bring it all the way back around. Semiconductors are not over. What actually ended was the era of throwing money in with zero calculation attached to it. And the people who understand that one difference are exactly the people who get to catch what comes next, while everyone else is still reading yesterday's panic headline. This is exactly the kind of money flow story I dig into every single week, following the money instead of following the headlines. If this helped you see things more clearly, hit that like button right now and subscribe so you don't miss where the smart money moves next. New rotations are happening constantly, and I'll be right here tracking every single one with you.